Hello and welcome to the first of 3 videos which make up this quarter's investment update. In subsequent videos we're going to look at what's been happening in markets and in portfolios, but this one's going to focus very much on what's been happening in the economy. And the economy of course has been one of the key drivers of what's been happening in markets. The 2 biggest factors have of course been interest rates and inflation. These caused many asset classes to fall last year and have continued to be volatile this year. And when we look at interest rates and inflation, I think it's really worth putting them in a historical context and remembering what an extraordinary time we've lived through. 3 years ago, of course, we were still in the pandemic. We might have been past the peak, but we hadn't yet had vaccines. We were still under forms of restrictions, and the economy was still in recession. 3 years ago, inflation was 0.25%. It then rose very, very sharply and got as high as 10.8% last year. And this year, it's of course been falling. Now that peak in inflation was far beyond what even the most pessimistic predictions were for inflation. For example, on screen you can see a chart from the Bank of England. This shows their predictions for inflation back in 2022 and then what subsequently happened. So the dark orange area shows their central predictions for inflation. What they thought was most likely to happen back when they produced the February 2022 Monetary Policy Report. The sort of lighter orange bands around it show the range around it, if you like, what they thought might be possible in a more extreme situation. The actual inflation is the white line, and this far exceeded even their most pessimistic predictions. So as a result of this high inflation, interest rates were put up very, very sharply. But again, I think it's worth putting this in historical context. So on screen, you can see now how UK rates have moved over the last 30 years. The steep increase you can see at the end, you can see just how extraordinary that is compared to other moves in the last 30 years. But that steep increase just happened over just 2 years. So 2 years ago, interest rates were 0.25%. Now they're 5.25%. And they've actually gone up by 3% in just the last year alone. With such huge moves, it's no wonder that asset classes fell. With hindsight, it seems clear actually that what's happened in inflation has actually been caused by what happened in the pandemic. So if we remember back where we were 3 years ago, central banks, governments pumped huge amounts of stimulus into the economy, huge amounts of money, just to try and keep things going. Now in the end, we discovered vaccines much more quickly than perhaps anybody had imagined. And so the recession that we had actually was much shorter than most people would have thought. So in hindsight, perhaps there was too much stimulus pumped into the economy. And of course, they didn't know that at the time. And perhaps if you'd have offered them the option and said, if you get this wrong, you end up with a bit of inflation, they'd have said, that's a price we're willing to take. But hopefully, nothing like that is going to need to be done again in the near future. And so therefore moves of this magnitude in interest rates and inflation are very, very unlikely to be repeated in the near future too, in our view. And we are seeing signs that inflation is now coming down. So normally when we look at inflation, we'll look at it over rolling 12-month periods. So if you look on screen now, what you see is the chart, the blue line on this chart looks at inflation in the way that we normally look at it. Rolling 12-month inflation, how prices have moved from one month to the next. And you can see that's coming down relatively slowly. The red line on this chart, though, is looking at rolling 3-month inflation. And here, it's been much more volatile, but at the moment you can see that over the last 3 months, inflation has essentially been zero. Now we can't say, of course, whether this will continue, but central bankers have recently been at pains to say that they are pretty much done with interest rate hikes. But instead what they want to try and do is keep them at these current kind of fairly high levels for some time. Now normally if you chart interest rates, it looks a little bit like the Matterhorn. Essentially rates are put up fairly quickly and they keep hiking rates until something breaks in the economy. And then at that point they're then forced to cut interest rates again just as quickly as they put them up. This time, they're determined to stop hiking before they get to that point. Instead, they want to keep rates at these current levels. So if you charted interest rates, they would want that chart to look a little bit more like Table Mountain and less like the Matterhorn. Now, whether they're able to do that in reality, will depend very much on the final part of the jigsaw, which is, of course, economic growth. Again, put that in historical context, the economy was in recession 3 years ago. And once more, I think it's worth looking back at how the economy has done versus what people were predicting a while ago. So once again, you can see on screen what the Bank of England thought would happen. This is what they thought would happen in February 2022, and then what subsequently happened. So the blue line is what they thought would happen. We'd get some reasonable growth. But then after the turmoil of last year, especially the mini budget, Trussonomics, etc., predictions were cut sharply, and the grey line is what they were then predicting. The orange line is what actually happened. It was somewhere between the two. So economic growth wasn't as good as they were predicting a couple of years ago, but it also wasn't the sharp recession they thought would happen last year either. Just bumbling along with some pretty anemic growth. So if the economy has done a bit better than expected and inflation's been higher than expected, that's why they've had to put up interest rates more than expected too. However, we now see signs that the economy is starting to slow. We look at forward indicators, we look at various surveys, and one that we find quite useful is something called the Purchasing Managers Index, or PMI. And essentially this asks businesses how things are going. And in the past, that has tended to be a pretty good indicator of what's happening in the wider economy. So on screen now, you can see what is happening with the PMI at the moment. So the blue line is the PMI, and then you've got the grey bars on there have been quarterly GDP growth. So you can see typically they tend to move in the same direction. And historically, when the PMIs have been at these levels, we've often seen a mild recession. Not a really, really steep recession, but certainly some sort of downturn. So again, we don't know whether or not that's going to be the case, but if we put all these things together, the evidence that we can see is the economy is starting to slow and inflation is starting to slow down as well. And as a result, we do believe that interest rates have probably now peaked, as the central bankers keep trying to say to us. Now, if we did go into a bit of a downturn, especially a mild downturn, now that wouldn't be good for certain asset classes, but what it would do is it would make interest rate cuts much more likely. And that would be very, very good for certain other classes like bonds and even certain types of equity. So in subsequent videos, we'll look at what's been happening in markets in a bit more detail and what the outlook may be for those. So thanks very much.